What's going on? It's your boy Gallon Gone. And I'm here to tell you why I love to trade 0 DTE long strangles. The reason is simple. It allows me to be very flexible in choosing direction. I don't care if the stock goes straight up to the moon or crashes down to zero. I make money as long as it moves in a big way. The more it moves, the more money there is to be made. That's what makes this strategy, this option strategy, an incredible strategy. But it does have some drawbacks, and we're going to discuss that. Okay, let's start by breaking down the anatomy of a long strangle. And so first, you have to understand, every time you hear some type of option strategy, whether it's an iron condor, a bull put spread, bear call spread, whatever fancy name that they're using, just understand it. It's simply a combination of a call or a put and a combination of buying or selling whatever that call or put is. And so we all understand the basics of buying a call. At least I hope you do understand this. So when you buy a call, whatever, let's say you have a $15 stock. If you buy a call at the money for $15, that means you expect the stock price to rise above $15. You make money if the stock price rises above $15. You lose money if the stock price falls below $15. Now let's talk about a put. If you have a $15 stock and you buy an at-the-money put for at the $15 strike, if the stock falls below $15, the put, you make money off the put. If the stock rises, you lose money. So puts, you expect the stock to fall. A call, you expect the stock to rise. A long strangle combines buying a call and a put together. So if the stock rises up in a big way, or falls in a major way, you print money. Now, the visual examples that I provided did not include the Greeks, implied volatility, theta, delta, and vega, the three ways that you make money selling options or buying options. You must consider the Greeks. In a perfect world, you can buy an at-the-money call and an at-the-money put minus implied volatility, and your break-evens are at the money. But implied volatility pushes your break-evens out, away from the strike that you buy it at. Now, we don't want, personally, I don't buy a call and a put at the money together. That forms a straddle. That is a different strategy than a strangle. The risk graph is very different. There's huge losses on a straddle, at the money straddle. For 0 DTE, I don't like to trade those. And it costs more money also. That's why the losses are larger when they do occur. So I like to buy out of the money strikes. So the out of the money strike would be a 13 and an 18. Like 13 put and an 18 call. They're out of the money because they're away from where the current price of the market is trading right now. So to enter in our long strangle, we're going to buy a 13 strike put, and we're also going to simultaneously buy an 18 strike call. And it's going to form a risk graph that looks like this. So this brings me to the drawbacks of a long strangle. You can see that if price stays between $13 and $18, you incur a max loss. The benefit, though, of a long strangle is when price moves beyond what is expected. It's the oops moment where everybody gets caught off guard. That's when the true power of this strategy comes in place. And because of that, do not place this trade when it is typical, on a typical day. Place this trade during a day where the unexpected could happen. So here are a few examples of days where it's possible for the price action of whatever stock that you're trading will move above and beyond what is expected, and therefore your long strangle will print. FOMC days, when Jerome Powell is announcing whether he will raise interest rates or lower interest rates. If the overall market is expecting him to lower interest rates and he goes ahead and he raises interest rates, guess what? It's taking everybody off guard because what was expected did not occur. CPI, Consumer Price Index. If the market is expecting lower inflation rate and the inflation rate ticks up, guess what? The market's going to move in a major way because what is expected was not what happened. Technical levels. When the market is approaching whatever stock that you're trading, if it's approaching a major technical level like the 50 SMA or the 200 SMA on a weekly chart, those are major resistance and support levels. They can bounce up or reject downwards, so pay close attention to that. Options expiries. So when options are about to expire once a month, the third Friday of every month, those are the Thursday and that Friday, those are the opportunities where the market can move in a major way. An example, yesterday was January 19, 2024. The S&P 500 reached an all-time high. January 19, 2024 was also an options expiry day. I placed a long strangle on that day and I made a profit. End of quarter quad witching is another example of a potential major moving day. So at the end of every 3 months, big money, all the heavy managers, they have to rebalance their portfolios and they're moving money around. And that has a lot of potential for unexpected, oversized moves. Earnings reports. If you're whatever stock that you're trading, if they underdeliver on what is expected that they should have earned, guess what? The market's going to move big. Major news catalysts. If there's major negative news that will impact the future profits of a stock, whether positive or negative, well, if the news is positive or negative and it's perceived that in the future their profits will grow or shrink, big moves, but you know that. So those are just a couple examples of days and times and opportunities that you will have to place long strangles. With that said, though, be very mindful of implied volatility, because if you overpay for your long strangle, you could still be at a loss even though price has moved in a major way. It's just you paid way too much and price could not overcome the money that you paid for. So keep that in mind. You stay tuned and I will go further in depth I will go further. You stay tuned. I will go further in depth on how to get the best possible price for your strangle to not hurt yourself. Stay tuned next video. Gallant gone.